A lot of people think having $1 million means you're set for life. But here's the truth. $1 million in the bank can shrink faster than you imagine. The real secret isn't the number itself. It's what that money can produce. And that's where dividends come in, because while bonds and savings accounts pay you the same amount forever, the right dividend stocks can hand you a paycheck that doesn't just arrive every quarter. It actually grows bigger year after year. That's the difference between barely surviving and truly thriving in retirement. Welcome back. I'm David, and on this channel, we break down money, investing, and financial freedom in a way that actually makes sense. If that sounds good to you, hit that subscribe button and let's jump in. Here's the thing. $1 million by itself doesn't guarantee freedom. What matters is how you use it. Right now, there are over 58 million millionaires worldwide, and yet many of them still stress about running out of money. Why? Because money sitting still eventually loses power. Take the safe option, U.S. government bonds. At today's rates, $1 million parked in 30-year treasuries pays about 4.7% a year. That's $47,000 annually, or just under $4,000 a month. Sounds good, right? But here's the catch. That income never changes. Your paycheck stays flat while your cost of living goes up every year. Thanks to inflation, in 20 years, that $4,000 will feel more like $2,000. Imagine living in retirement, watching your lifestyle shrink every single year. That's the silent danger of fixed income. So what's the smarter move? You need income that grows with you. And that's where dividends change the game. Unlike a bond coupon that stays flat, dividends from the right companies increase over time. Some companies have raised their payouts for 25, 30, even 40 plus years straight. That means your income keeps rising and rising faster than inflation. Think of it this way. Fixed income is like a paycheck that never gets a raise. Dividend growth is like working for a company that gives you a raise every single year. Over a decade, that difference isn't small. It's life-changing. And don't worry, we'll break down how to actually structure a portfolio to take advantage of this. But before we go further, quick question for you. If you had $1 million right now, would you rather lock it into something safe and fixed, or go for income that grows but carries some risk? Drop your answer in the comments. I read and reply to everyone. Now let's dig into the famous 4% rule, a strategy that blends safety, growth, and flexibility into one approach. So how do people usually try to turn $1 million into income? That's where the 4% rule comes in. One of the most famous retirement strategies out there. Here's how it works. If you have $1 million invested in a diversified portfolio of stocks and bonds, you withdraw 4% in the first year. That's $40,000. Each year after that, you adjust the withdrawal slightly for inflation. The goal is simple. Make your money last about 30 years. It sounds easy, but here's the reality check. The 4% rule was designed in the 1990s during a time of lower inflation and higher bond yields. Markets don't behave the same way today. Some years your investments go up, some years they go down, and pulling money out during the wrong year can really hurt your long-term results. That's why many experts now call it more of a guideline than a guarantee. Some say 3.5% is safer. Others say you can push to 5% if you're flexible. It all depends on your spending habits and risk tolerance. But here's the key takeaway. Unlike bonds, the 4% rule uses both dividends and growth. You're not just clipping coupons. You're letting your investments work for you while you take small, calculated withdrawals. This way, your money has a better chance of growing faster than inflation. Think of it like this. Bonds are like living on a fixed salary that never goes up. The 4% rule is more like running a small business. Some years you have to be careful. Other years you can give yourself a raise. If you're finding this useful, do me a favor, hit the like button. It helps more people find this video, and it lets me know you want more deep dives into practical wealth strategies. Now here's where it gets even more interesting. What if you didn't have to rely only on the 4% rule? What if you could combine strategies to smooth out the income and make it more reliable? That's where the new 4% rule and dividend growth investing come in. And trust me, this is where things start getting exciting. So we've covered the classic 4% rule, but here's the problem. It doesn't always feel stable. Some years, your withdrawals eat into your portfolio more than you'd like, especially if the market is down. That's why many investors now lean on a new 4% rule, one that blends together different income sources instead of relying purely on selling assets. Here's how it works in practice. You still withdraw around 3.5% to 4% each year. But instead of taking it all by selling investments, you mix in dividends, interest from bonds, and small asset sales. This way, you're not forced to sell stocks in a down market just to pay the bills. Let's put some numbers on this. Say your portfolio throws off 2% in dividends, another 1.5% from treasuries or bond ETFs. That's already 3.5% covered automatically, and you only need to sell a little bit of stock to hit your 4% goal. Suddenly, your income feels way smoother and less stressful. And here's where dividend growth investing, DGI, changes the game. The right companies not only pay you dividends, they raise those dividends every year. Think of companies like Coca-Cola, Johnson & Johnson, or Microsoft. They've been increasing payouts for decades. So instead of your paycheck staying flat, it climbs over time, often faster than inflation. Imagine getting a raise every single year, even in retirement. That's what dividend growth can do for you. Now combine that with bonds for stability and a few stock sales when markets are high, and you've got something much stronger than the old 4% rule. It's like upgrading from a shaky 3-legged stool to a solid chair with 4 strong legs. Your income becomes balanced, stable, and growing. Quick question for you. Would you feel safer relying on pure withdrawals, or would you rather mix dividends and bonds into the plan? Let me know in the comments, because your answer will help shape the strategies I cover in future videos. Up next, we'll pull all of this together into a hybrid strategy, the blueprint that lets you turn $1 million into an income stream that's stable today and growing tomorrow. All right, now let's put the pieces together. If you've got $1 million to work with, here's a hybrid approach that balances safety, growth, and income. 1/3 into long-term treasuries or bond ETFs. This gives you a stable, predictable income stream. 1/3 into a broad stock market index fund, so your wealth grows with the market and you can trim 4% a year without fear of running out. 1/3 into a dividend growth portfolio or ETF, where your paycheck grows year after year, often outpacing inflation. This mix creates a portfolio that checks mark, pays you steady income today, grows your purchasing power for tomorrow, protects you from the risk of outliving your money. Think about it. You're not just building an income stream. You're building a rising income stream. That's how you keep your lifestyle intact, even 20 or 30 years into retirement. And here's the kicker. You don't need to follow this exact formula. Maybe you're more conservative and want more bonds. Maybe you're growth oriented and want more dividend stocks. The beauty of this strategy is that it's flexible. It adapts to you. If this clicked for you, hit that like button so I know to create more deep dive strategies like this. And if you're serious about building long-term wealth and income, make sure you subscribe, because every week I'm sharing strategies that help you make your money work harder than ever. One last thing, most people fear running out of money more than anything else. But if you focus on building growing income streams, that fear disappears. Instead of wondering, will I have enough? You'll be asking, how much more freedom can this money buy me? That's the power of smart portfolio design. Thanks for watching, and now go check out my video on how to get rich with compound interest to take this strategy to the next level. We'll see you in the next video. Thanks for watching.